1939, mainly to cover the Europeans and Asians, but was later expanded in 1946 to cover the indigenous African employees who are mainly artisans and clerks at that time. The provisions also continued in 1994 under the pension scheme statute number 4 that consolidated the teachers, local government and traditional schemes, and then also increased the retirement age from 55 to 60. It introduced the survivors benefit, and it reduced the accrual rate from 2.4 to 2.0, the accrual rate being the rate at which pension grows. It's also anchored in the Constitution in Article 254, that is Section 1, 2, and 3, and the Pension Act Cap 286, or what we call Cap 29 one of these days. The scheme benefit basis, that is, it's defined by scheme rules and it's determined by a formula. The formula is based on number of years of service and the amount earned at retirement. It's mainly a pension fraction of 1 out of 500 times the period of service that is calculated in months and the last pensionable salary. You also have to put in mind that the qualifying period for someone to be pensionable or an employee to be pensionable is 10 years. No, it's not going down. Some of the benefits for some of the weaknesses in the design of the reformed scheme is that it's non-contributory. It being non-contributory, it has become so expensive to government to sustain. The fact that we are drawing monies from the consolidated fund and not contributing any to the fund, it has put a constraint on government. And then the final salary defined benefit nature, the fact that you're paid what you've been earning on before retirement, as in your last pay on retirement, it limits any changes in the amount that you're being paid. And then early retirement is permitted without reduction in pensionable period. It doesn't matter what form of early retirement you're taking, but you're still being paid for a particular period without reducing the amount. At the end of the day, it is really expensive. Then you're still getting a gratuity and then a full pension after being pensionable for 15 years. That cannot be sustainable in the long run. It really strains government. And then the portability of benefits. If I'm transferring services to an agency, I'll not be paid my benefits on transfer. I'll be paid the benefits when I retire. So the fact that I cannot be paid my benefits, it hinders one's mobility to move to another entity. And then there is no flexibility in benefit. Then under institutional structure, there are no provisions on constitution via the management structure. There is no structure anywhere in the Constitution or in the Pension Act of how this fund should be run. And then employees' pension rights are not fully protected because one can exit totally without pension, especially when they are resigning, when they are terminated or dismissed or have absconded from duty. And then even the other party who is entitled to the pension is dependent on treasury or a budget. If there is a budget to pay that someone is paid. If there is no budget, then that someone has to wait until there is an available budget to be able to be paid their benefits. Then absence of a comprehensive governance framework. All people who are retiring are at the mercy of the entities where they are retiring. And when there is a budget constraint, when they can't pay everyone who is retiring at the same time, then they are the ones to determine who gets paid and who doesn't get paid, simply because there is no governance framework. And then enforcement on disclosure and governance. Amid this being an audit or a special audit done once in a while, and the regulations in place, especially on decentralization, we can't really tell what everyone is doing on ground. We can only know when there's been an audit, which is very disadvantageous to us. And then the financing part of it, you all know that we draw funds from the consolidated fund on a pay-go basis. So if the budget is not available, then less monies will be released and less pensioners will be paid. And at the end of the day, we accumulate more areas that will need to be paid when the monies are there. Then there is also a weakness in financial planning, monitoring, and controls. Being that we draw monies from the consolidated fund, we base on a budget that is drawn on an annual basis. You'll find in most cases that we draw budgets and submit them, but they release less money compared to our needs. So at the end of the day, we pay out less pensioners compared to how we budgeted. And then there are no independent audits, except occasional forensic audits. There are no regular actuarial valuations. Actuarial valuations, they always help a government know what they are obliged to pay out. For example, they can know how much they'll be able to pay out in the next 5 years. But when they are not done on a regular basis, it's hard to know what their obligation is. And then other challenges, there's unfairness and some form of inequitability of the scheme. You find that the lowest pensioner is being paid 5,000 shillings, and then the highest pensioner is being paid as much as 26 million, which is so unfair. And then the affordability part of it, the fact that we don't have the enough monies to pay out all pensioners, it always leads to budget shortfalls, nanny payment, or delayed payments of benefits. Then sustainability, we have a growing size of the public service. And then the salary enhancement reforms have really caused the scheme not to be sustainable. And the longevity part of it. Remember, right now, people are living longer than it had been in the past. And remember, a pensioner, the longer they live, the more money they are paid because they are entitled to a lifelong annuity. So the longer they live, the more we spend on those pensioners, which is a challenge. And the fact that we are drawing money from a consolidated fund with a budget, there is no guarantee that you're entitled to a pension because it all depends on a budget. And then there are governance issues that have always caused nanny payment and delayed payment and then extortion. Due to the budget constraints, entities will be willing to pay that someone who is willing to part with a bigger percentage to the people who are paying him. So if you're not willing to do that, then you won't be a priority to be paid. At the end of the day, there is a lot of extortion. The growing size of the workforce, I've already talked about that, which has caused a lot of public expenditure, especially on wages and pension. So what are the reform propositions to cover some of those challenges? The institutional reforms to address the governance issues by establishing an independent public service pension fund that has a board of trustees and a professional body to run the fund. Then the reform to address the long-term physical sustainability with the pre-funding or with the contributions that we shall be making. There will be physical sustainability for the scheme, which will be long-term. And then the affordability part of it, the fact that there is pre-funding and prudential investments. Prudential investments will be done following an approved investment policy. So with that, we shall be assured of an affordable scheme, and then the adequacy of benefits and social security will be guaranteed due to the prudential investments. There will be returns that will be enough for us to have enough benefits. So no matter when someone retires, he or she will be able to be paid at that time when he or she retires. And then with the prudential management and investment and good governance, eventual benefits that will be paid to the retirees. So what are some of the reforms design expectations? We expect that it will be a modern and progressive scheme that will offer financial and social security. It's expected, and then it will result in a reasonable cost burden of financial affordability that is transparent, predictable, easy to monitor and controlled, and it will ensure that members meet a share of the cost of the improvements through the regular contributions that will be made. Will be consistent with the social and economic fabric, will be comparable to other similar public service schemes in Africa, like in Kenya, Tanzania, Ghana, Botswana. All those countries are running this form of scheme and they are doing well economically. It will be simple and easy to communicate. There will be a number of applications where the members can easily lodge in their complaints or check how much is being remitted for them on a monthly basis. There will be very many modes of communication to ensure that the scheme moves forward. Then contribute to increased national savings. You know that when there is consistent cash flow, then there are enough savings in the country. And then it will create a minimum disruption and transition. The fact that we are running the current scheme and the new scheme concurrently until the last pensioner in the current scheme exists, it minimizes the disruption and smooth transition. The same applies to the legal risks that might be involved. So some of the solutions to the scheme challenges. Parliament enacted the Public Service Pension Fund Act 2025. The Act is to provide for the establishment of the Public Service Pension Fund and Public Service Pension Scheme, governance, functions, organization and management of the fund, the collection of contributions, payment of retirement benefits by the fund, investment of monies of the fund, and for related matters. His Excellency, the President, assented to the bill on 10th April 2025, and on 10th April 2025, signed the Public Service Pension Fund Bill 2025 into the law, the Public Service Pension Fund Act 2025, number 5 of 2025. The Act became effective on 1st February 2025, number 1 of 2026. The Act repeals the Pension Act. Repealing is like revocation or cancellation. It revoked the Pensions Act Cap 89, or what others know as 286, and established the Public Service Pension Fund. The scheme provides for the collection of contributions, investment of the fund, and payment of retirement benefits. There is a time someone was asking a question whether members will be involved in the decisions of investing the money. You have to be assured that your monies will be safe, because there will be an approved investment policy for the fund managers to follow while investing your money. And the Act consists of 5 parts and 2 schedules. You can access a copy of this Act on the Public Service website, or Alan can drop a link in the Q&A tab for the listeners to follow the link and get a copy of the Public Service Pension Fund Act. So part 1 deals with the commencement of the Act, interpretation of keywords and phrases, and application of the Act and objects of the Act. Part 2 establishes the Public Service Pension Fund, functions of the fund, sources of monies, Board of Trustees, its functions, procedure, and Office of the Chief Executive Officer, and other staff of the fund. Part 3 establishes the scheme, provides for membership of the scheme, registration and cancellation of registration of members, provides for mandatory contribution, investment of contributions, and payment of benefits. Now, what are the key features of the new Public Service Pension Scheme? Its name is the Public Service Pension Scheme, and it's a defined benefit that is contributory in nature. The coverage is for traditional service, teaching service, local government service, employees on contract, employees of other public service. That means that it excludes the judicial service and the UPDF, because they have their own schemes. And then membership is compulsory for all employees in the public service, all newly appointed employees in the public service, but it's optional for employees who are 55 years and above. If you're 55 years and above, there is an option of you staying with the current scheme or moving to the new scheme. That is optional for those who are 55 years and above. But those who are 50 years, it's compulsory for all of us to join the scheme. So the exemptions are members of parliament, because parliament has its own scheme called the Parliamentary Pension Scheme. Members of the UPDF also have their own scheme. Employees in other public service subscribing to already existing retirement benefit scheme. Those who are in other public service but you're already subscribing, let me say to NSSF, you cannot again subscribe to the Public Service Pension Fund. Then employees in the public service who at the commencement of this act have 5 years left, those are the ones that I talked about, the ones who are 55 years and above. Those who are choosing to stay with the current scheme, it is okay. And then those who are choosing to move with the new scheme, it also okay. Then employees retired from the public service before the commencement of the act. All those who are currently pensioners and are on the current scheme, they will not be able to join the new scheme. And then judicial officers, because they have their own scheme. Employees of security organizations are all excluded from the new scheme. Then the accrual rate was reduced from 2.4 to 2.0. I told you accrual rate is the rate at which pension grows. Then gratuity is still being maintained at a third for 15 years. Then it offers a lifelong annuity. That means that someone is, a pensioner is paid pension for as long as he's alive. Then maintains a computation. The pension formula is that it maintains a pension formula looking at the last basic salary and the number of years served in service. And then the contribution rate, it introduces a contribution rate of 15%. That is the employer 10% and the employee 5%. Though for the beginning year of contribution, that is financial 2027-2028, government will cushion the contributions for that year, and then we shall start contributing the 5% starting with 2028-2029. Indexation maintains a periodic adjustment of pension based on inflation and performance of the fund. Whenever the fund performs well, the announcement will be made by the board and there will be some form of indexation. And then the modes of retirement. These are the circumstances under which someone will be able to retire under the new scheme. On attainment of mandatory age of 60 years, on continuous service for 20 years, on attainment of age 45 and you've served for 10 years, which is the qualifying period, on retirement on marriage grounds for both males and females who have served for a continuous period of 5 years. In the current scheme, the males had complained that they were not being taken care of, so the new scheme is taking care of the males too. Then on compulsory retirement from service, or what we refer to as abolition of office or retrenchment. Then upon death, termination of probationary appointment, on retirement from the service in public interest, on dismissal from the service, upon transfer to other public service where a member is by law required to subscribe to any other retirement benefits other than the Public Service Pension Fund, where an employee resigns from service, where an employee, I'm saying that. One thing you have to be sure of is that with this new scheme, no matter which mode of retirement you're taking, you're getting something out of it. For those who will be terminated, abscondment, dismissal, all those there will be a refund of their contributions, unlike in the current scheme where we've been. And then the benefits and granting events, you'll only be pensionable on attainment of mandatory retirement at the age of 60, continuous service for 20 years, on attainment of 45 years, provided you've served for 10 years, on retirement on marriage grounds for both males and females after serving or contributing for a minimum of 10 years, on compulsory retirement from service or abolition of office stroke retrenchment, that is regardless of the years of service, upon death having served stroke contributed for 10 years, on retirement from service in public interest having served stroke contributed for 10 years, upon transfer to other public service where you're required to subscribe to another scheme, and then on short service gratuity, which is equivalent five times to the annual amount. This is the short service gratuity is paid to employees who have served for less than 10 years. Remember, 10 years is the qualifying period for one to be pensionable. And then marriage gratuity granted to an employee who retires after serving for less than 10 years. Then I've already talked about return of contributions. I say that if you're exiting on termination, dismissal, abscondment from service, and on resignation, they will refund the contributions that you've been remitting to the fund. Then a death gratuity where a public officer dies before serving or contributing for less than 10 years. Then still on the key features, the regulatory authority is Uganda Retirement Benefits Regulatory Authority, which supervises all schemes in Uganda. Then the role of the Ministry of Public Service will be policy reviewing and monitoring, though it will still be the pension authority too. The current pensioner stroke survivors, the current pensioners are remaining under the management of the decentralized entities. We shall still continue to budget and pay those pensioners as they leave or until the last pensioner exits. So the current scheme will run until the last person is paid off. Then accrued pension rights from the current scheme is safe. You'll be issued with what we call a retirement bond or a certificate of debt. Every employee below 55 years who is joining the new scheme will be issued with a retirement bond or a certificate of debt that shows how much government owes you. Eventually, when you retire, your retirement bond and the period that you've served in the new scheme, with the new scheme or with the fund, will be all paid out at once by the fund. And then the reporting will report to Parliament and copies to ministers and the permanent secretaries of Finance and Public Service. Then the new scheme is starting operations effective 1st July 2026, but the contributions will start 1st July 2027. And remember, I told you that for the first year of contributions, government is cushioning the whole 15%. Then as a new feature, they're introducing a minimum pension that is not to be less than a quarter of the last salary, but with the introduction of the minimum pension, you paid a gratuity or a commutation because they would have paid you more than you were supposed to have been paid. The minimum years, I've already said the qualifying period is 10 years for one to be pensionable. So what has changed or what is changing? The governance and institutional reforms. There is establishment of a fund, which is the Public Service Pension Fund, that is separate from the sponsor or that is independent. Then there is pre-funding. We are contributing 5% for the employees and 10% for the employer. Then our social security is guaranteed. Given that there is pre-funding, we shall have enough monies to pay off benefits whenever one retires. Then there has been introduction of the minimum pension, which is a quarter of your last pay. Then periodic review of pension, which is indexation, depending on the performance of the fund that is to be declared by the Board of Trustees. Provision for optional membership of government departments and agencies for employees who are in agencies and boards and commissions. You are allowed to subscribe to this scheme for as long as you don't have any other scheme that you're subscribing to. Then revision of the pension fund from 1/500 to 1/600. That's what I say, that the accrual rate has reduced from 2.4% to 2.0. Preservation of the accrued benefits of the reform, that is the past service. We shall be issuing a retirement bond for the past service. Your past service is secure. Then current pensioners to remain under the old scheme until the last person exits under the management of their entities. The explanation there is the explanation that has been on the slide before. And then introduction of new benefits in case of dismissal, abscondment of duty and resignation, which has not been with the current scheme. There will be an annual general meeting for all members who contribute to the fund to be given updates on the performance of the fund. Then introduction of series of regulatory regimes like the Retirement Benefits Authority, periodic compliance reporting through OAG, Parliament, and the Capital Markets Authority. So what are some of the expected benefits to, one, the citizens of Uganda? There will be better social services as a way of budget relief. The fact that we shall not be constraining government anymore for funding of the scheme, or they will be funding the old scheme with a smaller percentage compared to all of us being part of it. There will be some savings, and those savings can be used for other services that are important to all of us. Reduce cost of borrowings due to huge capital. Social transformation, as pension funds are key sources of infrastructure development. The fact that there will be a lot of cash inflow, and when we save or when we invest those monies, there is a big return on them. Some of the monies can be used to improve infrastructure within the country. Then to the members, stroke the public officer and the staff. The pension formula has been retained under the proposed reforms. Amidst us making a contribution, the pension formula has been retained. When you look through it, you realize that at the end of the day, with the introduction of the retention of the pension formula, we shall be able to get more money out of it compared to only our contributions. Then guaranteed pension benefits, the fact that there will be pre-funding, shall be guaranteed of our benefits whenever we are due for retirement. Then there will be timely payments still due to the availability of funds. Then with the representation of the Board of Trustees, we are well assured of transparency, good governance, and accountability. And our monies will be safe because they will be managed by a professional body, the fund managers with an approved investment policy. And then government, there will be trust and confidence in the social protection system. Somehow with this old scheme, a lot of people had lost confidence in government. And then physical sustainability means other productive sectors. Reduce physical burden, the fact that we are not asking for more monies from them, they'll have some relief and be able to use the monies elsewhere. And then availability of capital for local borrowing. And then to the economy, of course, there will be increased savings in the economy, increase in the supply of funds that would reduce the cost of capital, the interest rates on borrowing would reduce. So what is the implementation roadmap? In financial 2024-25, the bill was enacted, implementation of pre-reform activities commenced. There have been a number of pre-reform activities, just like the one we are doing today. The sensitizations have been done to a number of forums and a lot of documentation has been done in preparation for the operationalization of the fund, the structures, the manuals, policies. A lot has really been done during the implementation of the reform activities. Then, which is also the same as 2025, 2026. Then 2026, 2027, commencement of the Public Service Pension Fund Act 2025. The board was already inaugurated and staff have been secondment for the interim management of the fund from different ministries. Then 2027, 2028, that is when the collections will commence. Then there will be appointment of the service fund managers. Fund managers are the ones who are in charge of investments. It's a professional body that is in charge of investing your monies. Then the custodians, who are the banks where the monies will be kept, the actuary, and other relevant service providers in accordance with the Act and the UBRA Act. So what are our roles and responsibilities as stakeholders? There are a number of stakeholders involved in the operationalization and management of the Public Service Fund. One of them is Ministry of Public Service. And one of its roles and responsibilities is establishment of the Public Service Pension Fund that has been established, appointment of Board of Trustees with their terms and conditions that has already been done, approval of regulations, policy guidelines for the service and the pension fund, as well as supervision of the Public Service Pension Fund. That is something recurrent that will be on and on all the time. Working in collaboration with appointing authorities to determine terms and conditions of public service, who are the members of the scheme or us who are going to contribute to the scheme. The Permanent Secretary, Minister of Public Service, still remains the Pensions Authority. Then coordinating the registration of members and collection of contributions. Then Ministry of Finance, Planning and Economic Development, monetary policy, and ensuring compliance with the public finance. We all know the role that Ministry of Finance plays. We draw the budget, then they're the ones who allocate the monies. They'll finance the startup activities and they'll finance the fund. And then technical support through board representation as being Ministry of Finance and the ones who have a representation on the board. So there's already a board member from Ministry of Finance. And then UBRA, which is the regulatory authority, it's responsible for licensing, supervision, and regulatory certification. All those who are appointed as Board of Trustees, they went through what we call a fit and proper test by UBRA. It's not that people are just handpicked and dropped in there. They all qualify to be part of that because they have to undergo some certification through UBRA. And then it advises the pension fund on several aspects, including asset classes for investment of pension funds and other aspects related to pension fund management. Then Capital Markets Authority, it regulates the financial markets and supervises the investment of pension funds, issues licenses to fund managers, and provides technical support in the development of investment policies. As I told you earlier, that we shall have an approved investment policy that will be used during the investment of monies. And then Parliament of Uganda, as usual, is the oversight of the operations of the fund through annual reports and reports of the Office of the Auditor General, enactment of laws for the pension fund and retirement benefit sector in general. You know, at the end of the day, they're the ones who approve the budgets allocated to the different entities. And then Office of the Auditor General, it will continue during the annual audit of the fund directly or indirectly. They might choose to appoint another entity to do the audit on their behalf. And then ministries, departments, agencies, and local governments, facilitating the registration of members of the pension fund. We all know that as entities, we are the ones to facilitate the registration of members of the pension fund. And then budgeting and remitting the employee and employee contributions. This has to be done on a monthly basis. Failure to do this, there will be a penalty of 1.5% to the accounting officers for failure to remit the employee contributions to the fund. And then notifying the pension fund on changes of employment terms. One thing entities have to know that every change on the employment of an employee who is contributing affects the operations of the fund. So it's important that any form of change is communicated as early as possible. That is on appointments, on promotions, on change of salary, on leave without pay, on interdiction, on retirement and death, and any other information. Then filing returns on member records, contribution collections, remittance, and other matters related to the pension fund. There will be need to reconcile between what has been remitted and what is pending and the reasons as to why it's pending. Then budgeting and payment of pension for pensioners under the past service. As I already said, the old scheme will run until the last pensioner exits. So the process continues as it has been done before. The budgeting and the payment will continue for those pensioners on the old scheme. Then managing claims of unpaid benefits from the past service, budgeting, payment, and accountability for the fund. Forwarding applications for retirement benefits of employees leaving the service to the Public Service Pension Fund. You'll be required to write letters introducing retirees who have retired from your entities to the fund as a way of ownership. So what are some of the key messages to us all? One is that the ministry constituted a team of experts across government institutions to draw regulations, policies, frameworks, guidelines, and systems to establish the fund. I already told you that there have been a lot of pre-reform activities that have already been done. And then benefit payment does not depend on the consolidated fund. We are no longer drawing monies from the consolidated fund because of the pre-funding. And this guarantees payment of benefits on the due date. The moment you retire, you're paid your benefits. I've already said that there've been a board put in place with diverse experience and are ready to assume office effective 1st July. As already said, full commencement of the fund is 1st July 2027. That is for contribution, though operational, it's 1st July 2026. Retired public officers before July 2027 will continue to be the responsibility of government. I've already said that the people on the current scheme or the old scheme will continue with the current scheme until the last person exits, which is projected to be around 2086 to 2087. Then pension rights and the unfunded non-contributory, which is the old scheme, will be protected through a retirement bond. I already told you that your past service is safe. You'll be issued with a retirement bond or a certificate of debt to show how much government owes you. That will be redeemed at your eventual retirement. The pension formula has been revised downwards by 0.4%. I already told you the accrual rate has reduced from 2.0% from 2.4% to 2.0%. As I already said, that government will cushion the 5% contribution for the first year of contribution. That is 2027, 2028, and then we shall start contributing 2028, 2029. It is anticipated that the pension fund will grow from 1.3 trillion in the first year to 6.5 trillion in year 5 and 26.5 trillion in 15 years in contributions alone, which means that we shall have the affordability, sustainability, and social security will be guaranteed. The fund will be self-sustaining by 2028, 2029. The government will fund the fund activities for the first year until it's self-financing. So the reform is envisaged to address liquidity and physical sustainability. With the pre-funding, we shall have enough money, which will eventually increase the physical burden. Then the bill will aim to achieve social security, and this, which is an objective under the National Social Protection Policy of 2015. It will also result in timely payment. As I already told you, that since we'll have enough monies, someone will be paid as and when they retire. The payments will be timely and not delayed in any way. Then the Public Service Pension Fund will be administered independently by a professional team of Board of Trustees, just like NSSF. It will be independent. It will have a professional team different from Ministry of Public Service under the supervision of a Board of Trustees who are also highly qualified in this particular field. The investments will be guided by the investment policy approved by the board. I've already talked about that, of course, in line with the UBRA Act. So what is the way forward? The entities are expected to update the human capital management system and ensure that employee data is accurate and clean. You have to ensure that the moment this data is inaccurate, that means that if the actuarial analysis is undertaken, we are likely to get inaccurate information. And that means that the retirement bonds might have inaccurate information. So entities have to ensure that all the information, all the data on the HCM is accurate 100% for us to be able to reach our objective. Then you have to map employee eligibility, all those ones who are 55 years and above. You have to know who is 55 years and above, who is willing to stay with the old scheme, and who is willing to move to the new scheme and have a budget for that. Then in financial 2027, 2028, when the contributions are starting, we have to ensure that the 5% salary enhancement that government is supposed to cushion us with has been budgeted for. And then audit past service liabilities. Like I've said, we have to ensure that the data is accurate for us to be able to audit the past service and offer the retirement bond values for the transiting employees. And then we have to monitor contribution timelines and ensure that monies are remitted on time to avoid the 1.5% penalty on outstanding remittance. Then conduct in-house workshops. You have to trickle down the information. You have to sensitize your subordinates, your other employees, especially the primary teachers and the police who take up the biggest percentage on the public service payroll. You can use your local radios, you can use different gatherings, you can use different forums to ensure that information has been received by all stakeholders. And then distribute retirement bond statements. When the retirement bonds are finally issued after the actuarial analysis, we expect that you issue them out to the different employees of your entities. And then we have to continue doing the pre-retirement pre-retirement training, especially for those who have less than. Later guidance shall be issued to responsible officers on the different modalities of reviewing the terms and conditions of service by the relevant appointing authorities. So unless there is really any other issue that is pending, I'm very sure the panelists behind the scenes have answered all your questions rightfully. I don't expect there being any question that is pending to be answered, because I'm very sure of the persons who are behind the scene to answer those questions. But in case there is really a pending question that is not answered, please feel free to raise your hand so that we are able to answer the question, because we seem to have come to the end of our session today. Thank you so much for listening. I'm waiting for the questions in case they are there. In case there are questions, we are waiting. I think there is one question from one Willis Tumwine. Please go ahead and ask your question, Willis.
Yeah,
Tumwine.
Yes, please. Thank you very much, Madam Presenter, for the wonderful presentation. Good morning to all of us. Just a quick one from my side, please, for purposes of clarity. If you could elucidate further on what happens with an instance whereby somebody is below 55 years by the time we transition, that is 1st of July 2027, to the new scheme. And I would want to believe that they would have accumulated some money of theirs. And what happens to that money? It would appear like in the chat box, some good Samaritan informed me that one would be given what we call a retirement bond, and which is okay with me. However, from the economic perspective, I would want to inquire as to whether, if at all one is given a retirement bond of, say, 1 million, and he is to retire after like 5 years, will it be the same amount that they would recoup out of the coupon or the bond that would have been given to them? Because if that is the case, then it literally means money would have lost value. The 1 million would have lost value. Because surely, looking at the inflationary tendencies, 1 million today is better than 1 million tomorrow. So I would want to know whether it stays as 1 million, or you have insights of investing the same 1 million, say like in bills and bonds, maybe unit trust, which ultimately can at least bring on board some gain for this saver or this person who had been given a coupon of 1 million, just like we normally see with NSSF and so on and so forth. So as to guard against the inflationary tendencies, Madam. So kindly, if you could elucidate or clarify on that one as well. Yeah, thank you so much. Yeah, thank you.
Thank you, Wills. The retirement board will accrue interest. It will not be the same amount that was issued on the retirement bond like 10 years ago. It will definitely accrue some interest that will be paid out finally or eventually when you retire. Please. Charles Wandela, you have a question. Please go ahead. Charles Wandera, you have a question. Your hand is up. Please go ahead and ask your question. Maybe he put up his hand unknowingly. Charles Wandera, are you there? Chirongo. Charles Wandera, since you're not answering, Chirongo, go ahead and ask your question. Chirongo P, please go ahead and ask your question.
Hello.
Yes, please.
Thank you, Madam Nanono. Now, you talked about the Board of Trustees, of competent trust, Board of Trustees.
Yes, please.
You said it will be a board of trusted personnel and all that. I thought if we are to constitute the board, it should have representatives from the respective agencies. Me, I'm from MAIF, so I would expect to have a board of trustees from MAIF who is representing us on the pension scheme. That's my thinking.
Thank you, Mr. Chirongo. As I've said earlier, that we can all access the Public Service Pension Act from the website of Ministry of Public Service. And when you go through it, you'll find that we all have representatives on that board. There are representatives from different ministries on the Board of Trustees. That being Ministry of Public Service, Ministry of Finance, Ministry of Local Government, Ministry of Gender. But the unfortunate thing is that the ministry you're asking has no representative. But being that we are all under Ministry of Public Service, there is a representative. Then there is a representative for pensioners. There is a representative for the pension associations. Just know they are all representatives from the different fields of work. You can get more details from the Pension Act. Charles Wandera, go ahead and ask your question. Charles, your hand is still up, please. Charles, your hand is still up. Please go ahead and ask your question. Ronald Biaruhanga, go ahead and ask your question, please.
Good morning, Madam. Thank you for the beautiful presentation and enlightening us.
Morning, how are you?
Good. Transitioning from one pension scheme to another, what happens if I leave the public service and I join the Judicial Service Commission, for example? Can I get paid my benefits at that point while I contribute to the other side? Or am I allowed to leave my funds with the fund manager in the instance that I want them to grow? Yeah.
When you're transitioning, let me say, to the Judicial Service, the good thing is that the Judicial Service is not subscribing to any other scheme. So that means that you can either voluntarily continue subscribing this side, or you can choose to leave your money until you finally retired from the Judicial Service, because the Judicial Service scheme is still drawing monies from the consolidated fund. It's not contributory in any way. Charles Wandera, go ahead and ask your question. I think we don't seem to have any more questions from anyone. And I'm very sure that those ones under the Q&A tab have been answered by the panelists. Unless there is any other issue that is really pending, I would like to thank all of you for attending. Okay, I'll try to answer some of the questions that are in the Q&A tab. One anonymous attendee is saying, I don't think we are secure with issuing us a retirement bond. It will be better to deposit some of the benefits periodically to beneficiaries before retirement. It has already been put in the bill or the act that they will issue us with a retirement bond. We cannot run away from that. I remember the Public Service Standing Order says that you can only be issued with your retirement benefits at your eventual retirement. You cannot be issued with paid out retirement benefits when you've not retired. And then someone is saying we need more clarity, especially on some of us who have worked for over 15 years, then we begin saving now. You're not giving up on your past service, as we've already said. You'll be issued with a certificate of debt or a retirement bond showing how much government owes you that will be paid to you on your eventual retirement from the fund. So all your pensionable period will be paid out. There is nothing you should worry about over payments for your past service. And then there's someone called Pons Walter is asking, will the scheme provide for provident fund if an employee or entity chooses that path? We are not providing a provident fund. The only thing that we are providing is a gratuity and a pension. Though you can choose to leave the gratuity and it's paid out as a pension on a monthly basis, but not a provident fund. Then someone is asking, is the retired person going to get pension for 15 years after getting gratuity? Yes, it's still continuing. It's a lifelong annuity. When you retire and you get your gratuity, you'll still earn pension until you die. Then Martin is asking, if you have not been paying any contributions towards our retirement, does that mean that we shall begin saving now? What is confusing is that we have been paying, clarified. Now, one thing that all of you are confusing, you're confusing payee with the contribution for the fund. Payee is for everyone who is earning an income, no matter where you're working, everyone pays payee. But for the contributions, they're being paid to the fund for your retirement. And you're not starting to save now. I said we are carrying forward your past service through a retirement bond. So both services will be safe. At the end of the day, you'll be able to be paid out all your monies. Someone is asking, how do members benefit from accrued interest from funds investments? I told you that as we contribute that the 5% and the 10% from government, there will be a formula instituted at the end when you're retiring. When you use that formula and calculate, you realize that you're getting more out of what you contributed. That means that out of that formula, your interest is part of the monies that are being paid using that formula. How does one join? From Fiona, this is compulsory for all public servants who are below 55 years of age. Okay, I seem to have winding up here. There is no hand up, and I've answered all the questions, those that had not been answered. I would like to thank each and every one of you for listening in and to request you to inform a friend. Share the information as widely as you can so that all of us are informed of the new reform for pensioners or for those who are almost retiring. Thank you so much. Till next week. When we tune in for the next session, have a good day.